Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Things have been quiet since markets went on a Thanksgiving holiday, but one commodity that has been grabbing attention is gold. Now, gold has started comfortably trading above $2,000 an ounce, but other commodities in general have been rangy with not much of an action. In fact, even currencies have been range bound, with euro and British pound sustaining at higher levels against the dollar, but not having fresh moves. Good morning, JK. What are your thoughts on the recent moves? How are you seeing markets from here?
Good morning, Swaraj. So gold, yes, it's broken 2000, the first barrier towards new high. And I think this is very healthy because we had a consolidation for nearly a month. And after that, it started the move. And with the lower yields everywhere, gold seems to be very well supported. Immediate resistance at 2015, and then we'll be looking to retest the 2070 high, and we have enough triggers this week in the form of economic data from different regions as well. Back to the markets, other markets, we had plenty of economic data out on Friday, but not a whole lot of market reaction because they were thin. But as we stepped into the new week, we have seen the reaction, particularly from bond yields, which are actually the front runners for the market moves, and the much touted skepticism about big supply in 2 and 5 year auctions for over 100 billion evaporated yesterday. They got a very good response. So that combined with the poor new home sales data, which has come at minus 5.6 versus 8.6 plus last month, led to renewed buying of treasuries. 2 years fell by 6 basis points to 4.89, and 10 years by 10 basis points to 4.40 once again. Market expecting inflation numbers from US and Europe this week to dip further, and discounting shows up to 1% rate cut to happen in both the regions coming year. In UK, the market is expecting a 51 basis points cut next year. So all these things are going into the support for risk assets and support for gold as well. Particularly in Europe, where German yields fell 10 basis points, and possible more dovish statements from Lagarde has kept the markets on a very supported zone as far as the risk assets are concerned. But Euro did not really show much sign of relenting as it trades near multi-month highs once again at 1.0960. And Lagarde said that there are some signs job growth may lose momentum towards the end of the year. And that really did not put off the Euro bulls, possibly wanting to break the 1.10 barrier in the near term. But that said, currency markets have moved quite a bit in the last 1.5 months. Dollar index has moved down by almost 3%, and even the emerging market currency index has gained over 3%. All these things call for some sort of a consolidation, particularly as we head into the non-farm payrolls report for November, and then FOMC meeting on December 13th. So somewhere around these regions, I think dollar index remains supported for some time before we head into the year-end trade zone. Bond yields did recover after failing to break 4.30% once again. But now we really look forward to the core inflation number on PCE due on Thursday, and then the GDP number on Wednesday. GDP number had suppressed the upside at 4.9% last month. So we'll have to see what the second estimate indicates. But the leading indicator from the Black Friday sale in US shows the e-commerce spending popped up 7.5% from a year earlier, reaching a record 9.8 billion in the US as per the reports compiled. And it reflects a consumer who is no more willing to spend. He's more willing to spend than in 2022. In 2022, obviously, the gas and food prices were painfully high, and it was holding back spending. Online shopping deals as part of the Cyber Monday are also expected to entice whopping 12 billion sales. This is what the early indications are. So this means the GDP number going forward is going to be good, because the consumption happens to be 70% of the US GDP. Stocks have continued to consolidate after hefty gains of this month, 9% for S&P 500 and 11% for Nasdaq so far. And the market has looked at falling yields due to weak economy and bought the stocks along with this. But point to note is we are yet to get to a point where weakness in the economy prompts investors to dump stocks due to possible impact on earnings. So any weak growth in the economy obviously leads to lower demand, and then companies' earnings are likely to be affected. But that is not seen so far. People have been buying bonds as well as stocks, and that generally doesn't continue for too long. So yesterday we did see some profit taking in risk assets ahead of key numbers from the two major economies. Yen has also made some ground because of yield differential with the US coming down. And of course, yuan has been consolidating around 7.17 regions, 1617 regions after gaining 3%, waiting for more clues on the Chinese economy. In India, obviously, there is a crawling move that's happening in the USD INR, weakening by 1 to 2 paisa every day, inching towards the previous high of 83.42. But really no participation from the broader market. I mean, the speculators are conspicuous by their absence, and it's only the flows that are actually driving it. The good part of the flows is that we have this month positive flow for the equities as well as for the bonds. And as we get into the month of December, by when generally major global funds start allocating fresh money into various markets, including the EMs, I feel the positive side of the flow can start to reflect in the market. And in fact, we also have major trigger in the coming days. We have exit polls from the state elections on Thursday, when the last phase of the poll ends, and then the final results on Sunday. So these can serve as trigger for the rupee to give some directional move, even if the results are not in favor of the party at the center. I think market has discounted most of it, and my bias would be for some strength in the INR, particularly if the flows start to improve. Finally, there was also a news that S&P Global Ratings has hiked India's GDP growth rate forecast for 2023-24 to 6.4% from 6% earlier. However, this is still 0.1% lower than projection by RBI, but it's a confirmation of the global institutions recognizing India's superior growth, although it is yet to reflect in flows and the exchange rate. Thank you.
Thank you, JK. And one important data we had from the US was the new home sales, which was quite poor, cementing the rate cut expectations of the market from May 2024. However, if we see the recent the Black Friday sale, the e-commerce spending has increased 7.5% compared to last year, and it seems consumers aren't holding back as of now. For USD-INR, we have been weakening 1-2 paisa, but flows seem to be coming back in both equities and debt markets. We'll keep a watch of that. That's it from us today. Thanks for listening, and tune in tomorrow for the latest in the financial markets.